Now, the thing about this non-farm payrolls jobs is, yeah, they're not accelerating like in 2014. We actually had an acceleration of the job growth in 2014. So in 2015, it's lower, somewhere around 200,000. I think 2014, the average job gain was a month job gain for the month on non-farm payroll was about 260,000. But if you look back, going back to 2011, we pretty much added about 180 to about 220 on average every month. So this is accumulating job gains every month, which is pretty steady, and it adds up over time. So as far as the employment, if you take a look at the employment rate and then you take a look at the non-farm payroll jobs, not bad. That's the good side of the equation. Now there admittedly probably a lot of you out there that are saying, oh, hogwash and poppycock. That ain't true. A lot of people are taking jobs that pay a lot less. Yes. A lot of people have left the workforce. Yes, the participation rate is down. We don't hear about that much anymore. Market seems to have accepted that. Maybe people are retiring, stuff like that, or demographic shifts. And so there are these mixed signals that are going on in the market from the job perspective. But overall, I think the Federal Reserve is encouraged by the steadiness of the job gains out there and the consistency that we're seeing not only in the non-farm payrolls but also in the decline in the going the wrong way in the unemployment rate, the steady decline. 5% what is a pretty decent rate. Taking a sip. Pretty low rate. Remember back when I think it was around 2012 when the Fed was saying that if the unemployment rate goes to 6.5%, that will be a trigger point or the level that they would start to take back some of the excessive easing that they've done. Well, that came and went, and it's just another indication of the Fed kind of painting themselves in the corner. But 5%. Unemployment rate on the surface, not a bad thing. Non-farm payroll jobs around 200,000. Now, what's going on in the stock market? Stock market since 2011 moved up. Well, currently up around 80%. That's not bad. Was higher. We've come back down a bit, testing our lows here from 2014. Or this swing low from 2014. You can't really, even with this move to the downside, you can't really complain about that. That's been stimulated to the economy over time. More money in people's pockets, or they're increasing their balance sheet. Or their balance sheets are getting more healthy. When you take a look at the European stock market, yes, come down off the top here, but up 63% since 2011. The Shanghai Composite, a little more rough time of it, and that's been a big focus of late, is the China syndrome, the China issues, the China transition, which the second largest economy in the world. It's hard to ignore. But the Fed may just do that. This was artificially stimulated, perhaps from getting retail mom and pops in the market there, with saying the government's all behind this. It will crash right back down to from whence it started. So it's up over the last year or so. But from a low level right here, but certainly well off the highs. Who knows? China's a big wild card out there. Commodity prices, we know about them declining to the downside. So that, again, is an inflation thing that would keep the Fed from perhaps tightening. And crude oil down quite low. Iron ore prices, another measure of commodities, down very at low levels. down, well, from a 180, 190 all the way down to 57. That's a big, huge move to the downside. And 10-year note yields kind of sitting in the middle of a range here over the last 4 or 5 years. It's kind of waiting around, see what the Fed's going to do, see what the economy's going to do going forward. And finally, the dollar index. So what we're seeing in the dollar index is a 20% increase from this low right here last year to the current levels here. So that in effect can be a tightening for the Fed. It may stop them from tightening credit conditions in their meeting tomorrow, and that is because of that move to the upside here. Makes it it does the Fed's tightening for itself. For the Fed, so some people have argued that. And what do we know about the Fed funds target, though, is that the Fed funds target has been flatlined here for, I don't know, what is it, 9 years now? Or 8 years, 9 years, I don't even know. No, but we've been down at 0.25, so it has been down there low for a long time. And so all of this, all these charts, all this fundamentals, if you will, go into this big pot, this big cauldron, and make it a real difficult decision for the Fed. And honestly, looking at it, it's like employment's doing well. It could be a time that employment starts to kick in, more inflationary wage gains going forward. And that, I think, is what the Fed, if they are to tighten, will be focused on, is that it may not be there now, but down the road there's going to be some wage inflation. So what is my opinion? Well, if I were to have to get on, make a choice one way or the other, I would say that the Fed will start to lift off and raise rates by 0.25%. Understand that I am human, and this chart that I showed prior, with the Fed funds target sitting here at flatline for so long, after I'm not a youngin like a lot of you, or maybe not, but I remember my career started way back here, and I've always been for most of my career, I've been in a trading markets that move up and down with the Fed funds target. The Fed eases rates, they lower rates, they ease rate and lower rates. So it is kind of human nature for someone as old as me to kind of look for the change, the change. Things just don't stay the same as far as the Fed target forever and ever. That's the way I lived for all the way up until 2010 or whatever, when 2009, 2010. So it. That my idea that the Fed is going to tighten may be biased that way.